The market bounce has occurred, breadth has fully reverted, and the energy opportunity has finally arrived. I quantify it all in today's REKTelligence report. As a friendly reminder, everything in today's show is for informational purposes only. There is no investment advice given. All right, let's get into the show. Hey everyone, welcome. I'm Dave. This is the All Markets Report where I quantify across asset classes with an eye to the week ahead. This week's going to be all about equities, although in a few dimensions. Let's get into it. Okay, the first dimension is breadth. Let's take a look at this chart, which is the number of stocks inside the S&P 500 above their 20-day moving average. And last month, I was looking for this to fall to less than or equal to 15%. In other words, most stocks inside the S&P 500 not above their short-term 20-day moving average. That's exactly what we saw happen. This fell in the green box there to just below 15%, somewhere in the 12 neighborhood. It bounced around in that area for a few days. And we can see, though, by last week, white box, this had reverted fully. We had seen the number of stocks inside the S&P 500 above their 20 MA bounce to its highest level year to date. We see it's come down a little bit, but we have short-term seen a full reversion in terms of breadth. For those who might have missed the episode, here is when that signal actually hit, something again I shared last month. If you look on the lower right-hand side, you can see that white box. This shows the breadth measure falling to that 15% level, slightly below, and then the long signal you can see tagged on the upper right-hand corner. That is when this triggered. Now, in terms of the stats, historically, 2007 to when I quantified this a few weeks ago, there have been 60 instances for the SPY. So this does happen quite frequently, and you can see the hit rate, 70%, 42 out of 60. Profit factor, 2.143, pretty healthy number. Average trade in 1 month is not eye-popping, but it's certainly positive at 1.89%. And you can see statistically significant, that is huge to my analysis, and the REK score or REKTelligence score 49, which is respectable. It's, again, not something that gets me salivating to trade, but it's definitely a positive edge. Now, let's look at the long-term breadth measure that I may quantify soon. I'm kind of playing with some analysis of this now, so you may see this in the near future. Long-term breadth, S&P 500 stocks above their 200-day moving average is right at its own 1-year moving average. In other words, you can see that we never got to one of these extremes. You can see 2025 tariff tantrum right here. This fell down to 15% itself. This is a different measure. This is the 200-day moving average. So stocks above their 200 MA fell down to 15% last year during the tariff tantrum. We didn't even get close to that here during this period and this volatility around the Iran war. And you can see we are far from any kind of high extreme as well. Right back to where I started, we are at the 1-year moving average here. Traders, crypto is not a wild, unruly market. It's an asset class with 500% more time for price discovery and opportunity. My new course, Crypto Trader's Edge, is now live through Algo Advantage, one of the top quant pods and academies out there. A full systematic framework, backtesting, strategy development, validation, real edges with full code, not hype. Links in the description or head to my Substack at REKTelligence. Now back to the show. Let's move to the energy sector. And a quick note, in February, I did a report called the Coming Energy Opportunity, or something very similar, where I quantified 10% pullbacks from 52-week highs inside this sector and pullbacks which occurred within 2 months. Let's take a look at where we are now. Here we've got a major energy ETF, the XLE, Energy Select Sector Spider, and we have essentially pulled back 9%. So we're not quite at the 10% threshold, which I quantify in a moment, but certainly in the ballpark, and naturally this could meet the 10% threshold within days. So here's what I quantified in February, the 11th of February, in fact. And you can see XLE, 2000 to the present, there have been 18 instances in which this met those conditions. The hit rate, or win percent, 72.22%. Profit factor north of 2.176, very solid. And we can see total P&L, respectable, max drawdown 38.5%. All of this with a 3-month hold time. Now, I don't have all of the stats that I normally do currently in my reports. In February, I wasn't doing that, but certainly this would have a respectable R score. And let's move on, take a look at some of these others. IYE, another energy ETF, profit factor of 3.328 on 17 instances, hit rate of 82.35%, 14 out of 17, and a stronger P&L as well. Let's look at the VDE, Vanguard Energy ETF, 16 instances, hit rate, again, very solid at 81.25%, 13 out of 16 profitable, in other words, 3.5 profit factor, basically. And again, respectable edge. All very similar. That's not a big surprise. These are very similar ETFs, but all of them across these various markets showing essentially the same edge. All right, the last dimension for equities I want to cover in today's report is the weighted spread. Let's take a look at this daily chart of the NASDAQ 100 ETF, the QQQ. And one of the dynamics we saw recently was that while the Qs were down, the equal weighted Qs, or QQEW ETF, was down quite a bit more. So when the spread widens as it did, what does the market do, or the Qs do, with a 1-month hold? That's what I quantified, specifically of the last 60 days by Qs. If they're less than equal to negative 3% during that 60-day period, while simultaneously the QQEW is down at least 12%. Now, here are the stats in Strategy Analyzer. We can see that the hit rate is 76%, profit factor 5.07, and the number of instances are 25, by the way. So the hit rate is 19 out of 25 profitable. Average trade 4.44%, average win just a tick under 8%, 7.99, average loss 6.78. And a decent looking equity curve. The dip in the equity curve during trades 5, 6, 7, 8, and so forth, that is during the great financial crisis. Let's take a look at the scatter plot. You can see, again, the average is showing 4.44%. This is adjustable, of course, in Strategy Analyzer, so you can look at any period you like. This shows the whole period. And the scatter plot of trades, the worst being negative 23.7% and the best at 22.7%. Now I'm going to run a Monte Carlo analysis. I will use 1,000 simulations, although in Strategy Analyzer you can select 2,500, 5,000, or even less at 500, etc. I'm going to use it in edge robustness mode. That means sample with replacement. This stress tests the edge a little bit further, ensures that it's robust, or reveals that it's not really as robust as we might like. So here you see one of the outputs of the Monte Carlo analysis. You can see best observed, the first percentile, all the way down to the 100th or worst result, and everything in between. So let's skip the best observed. It's for fun, not really that useful as a trader. Median, however, is useful. We can see that this is the middle result, 181.06% cumulative return, max drawdown, negative 23.70, and profit factor, a little bit off of the 5 of the actual back test, but 4.171, not that dissimilar. And if we look down at realistic downside, that's the 95th percentile, we can see the cumulative return is a lot less now, 19.11% at the 95th percentile. Drawdown is much larger at negative 42.5%. And profit factor still positive 1.407, but move down to tail risk, 99th percentile, and we see that return is negative. We see drawdown is much larger at negative 55, and profit factor is below 1, meaning that it is not profitable. Worst observed, of course, is even worse. So the edge that is at play in terms of the spread between weighted and equal weighted right now in the market is already playing out, but it doesn't really stand up under serious stress testing as we see here with Monte Carlo. If you think Strategy Analyzer might be something you use, great for TradingView users, really levels up your TradingView analysis in many respects. You can go to my website, tradingfromparadise.com, and check it out. It will be released within weeks, hopefully days, and you can lock in your rate. There's a preferential rate. Details on the site, again, tradingfromparadise.com. Thanks for watching today's All Markets Report. We've just seen two equity reversion edges play out successfully to the upside, but the biggest takeaway of today is the energy pullback has finally arrived. Sure, it's a little bit light of the 10% I quantified, but essentially it's in the ballpark. I will be talking about that in the days to come, and I will see you in Thursday's Edge Report. Until then, trade smart, live well, and cheers from the Caribbean.